In 1971, a single decision broke the world from its golden leash, and suddenly money could be created without restraint. What sounds like economic chaos was anything but. The new era of inflation was not an accident, it was a strategy, rewriting the rules to favor the powerful. If inflation has always made the rich richer, whose plan was it, and what does that really cost the rest of us? For nearly a century, the rules of money creation were set in stone, literally. Under the gold standard, every dollar in circulation was chained to a precise weight of gold. The U.S. Treasury and the Federal Reserve could not simply print more money on a whim. Every new bill demanded a matching deposit of gold in the vault. By law, the Federal Reserve was required to hold at least 40 cents in gold for every dollar issued before 1933. Even after the Gold Reserve Act lowered that threshold to 25%, the system still held a hard line. No gold, no new money. Gold. This was not a symbolic gesture. It was a legal straitjacket that bound the hands of policymakers, no matter the economic storm. In the depths of the Great Depression, President Franklin Roosevelt confronted the limits of this system head-on. In 1933, Executive Order 6102 forced Americans to surrender their gold to the government. The following year, the Gold Reserve Act allowed the Treasury to devalue the dollar overnight. It raised the official gold price from $20.67 per ounce to $35 per ounce. This single move slashed the real value of public debt, expanded the money supply, and provided the government with new fiscal firepower. Savers who had trusted in gold found their wealth rewritten by decree. The lesson was clear: the gold standard protected against inflation, but it also blocked the levers of emergency power. Devalued globally, the post-war Bretton Woods system continued to enforce discipline. The US dollar became the anchor of world finance, convertible to gold at $35 per ounce. Foreign central banks could demand gold for their dollars, forcing the US to keep reserves in check. If the Federal Reserve printed too many dollars, gold would flow out of the country, exposing any excess. This external check kept inflation in line and tied the fate of global currencies to the US gold stockpile. Dollar. The numbers tell the story. From 1944 to 1971, U.S. gold reserves fell from around 20,000 tons to just over 8,000 as foreign governments, wary of mounting deficits and rising inflation, demanded gold in exchange for dollars. Every ounce that left the vault was a warning shot, a sign that the system's brakes were failing under the pressure of economic ambition. By 1968, even the last statutory gold reserve requirement had been lifted, but the international gold peg remained until the breaking point arrived. Brakes. The gold standard did not allow for experiments or shortcuts. It was a silent enforcer, demanding discipline from every government that dared to print its own currency. For as long as gold ruled the system, inflation remained a threat contained by law and by nature. But as the world's economies grew and the appetite for credit outpaced the supply of metal, the pressure to abandon these constraints grew impossible to ignore. Credit. On August 15, 1971, President Richard Nixon addressed the nation with a single televised sentence that rewrote the rules of global finance. The United States would no longer honor the dollar's convertibility into gold. The world's anchor currency was now untethered. No vault, no metal, no limit. In the days that followed, foreign exchange markets froze, headlines screamed of a new era, and the price of gold broke free from its fixed $35 plateau. Behind the scenes, Nixon's advisors had spent a tense weekend at Camp David, weighing the threat of a run on U.S. gold reserves against the demands of international creditors. Treasury Secretary John Connally, flanked by Federal Reserve Chair Arthur Burns and a young Paul Volcker, pressed for action. The outcome was not just a suspension, but a permanent severing of money from any physical constraint. The dollar became a fiat currency, its value declared by government decree, not by weight of gold. The Federal Reserve, once bound by the size of its gold hoard, now held the power to create money at will. No longer did new dollars demand a matching deposit of metal. The only break that remained was policy, not law. The decades that followed revealed the scale of this transformation. In the wake of the 2008 financial crisis, the Federal Reserve launched a new experiment, quantitative easing. Between 2008 and 2015, the Fed's balance sheet exploded from under $900 billion to more than $4.5 trillion. Trillions of new dollars flowed into the financial system, conjured not by mining or trade, but by keystrokes and asset purchases. The central bank bought government bonds and mortgage-backed securities from major financial institutions, crediting their reserve accounts with newly created money. The result was a tidal wave of liquidity that flooded asset markets, driving up the price of stocks, real estate, and corporate debt. This was not an isolated event. Each crisis brought another round of expansion. By 2022, the Fed's assets had surged past $8 trillion. The scale was unprecedented, but the logic was simple. Without gold, there was no upper limit. The central bank had become a technician, adjusting the dials of the economy with tools that were once unimaginable. The consequences of this new power would not be felt equally. The mechanics of distribution, the pathways new money traveled, would decide who gained and who paid the price. March 2020. Wall Street's trading floors are silent, and the Federal Reserve's digital ledgers blaze with activity. In a matter of weeks, over $4 trillion in new liquidity is unleashed, not to the public, but straight into the arteries of the financial system. The first stop is the primary dealers, the 24 powerful banks and brokerages with exclusive access to the Fed's money spigot. They receive the new dollars before anyone else, through channels with names such as SOMAPDCF and MMLF. The numbers are staggering. $3 trillion in asset purchases, $1.2 trillion in repo operations, $190 billion in money market support, and $35 billion in emergency credit, all before summer's end. This is the Cantillon Effect in motion. The first recipients of new money move fast. With fresh reserves in hand, they snap up stocks, bonds, and real estate, pushing prices higher before the rest of the world even feels a ripple. Asset managers, hedge funds, and institutional traders deploy capital with the speed of a keystroke. As markets rebound, the value of their holdings surges. A landlord with leveraged property sees rents resume and prices climb. A trading desk rebalances into equities, catching the first wave of a historic rally. Meanwhile, outside this inner circle, wages are frozen and uncertainty spreads. The structure of the system is no accident. The primary dealer pipeline ensures that new money fuels speculation and asset accumulation at the top. By the time this liquidity filters down to ordinary households, prices have already adjusted, leaving those furthest from the source to face higher costs without the benefit of early gains. The architecture is precise. Trillions flow in at the apex, widening the gap long before inflation shows up in the checkout aisle. A Detroit machinist clocks in before sunrise, his pay stub stamped with numbers that seem to shrink in the shadow of rising prices. Since the early 1970s, the story has played out across the country. Wages grow, but never fast enough to keep pace with the cost of living. The Bureau of Labor Statistics records the gap in stark detail. From 1980 to 2020, median weekly earnings climbed by just over 20% after inflation, while the Consumer Price Index more than doubled. Home prices tripled. Groceries, tuition, and healthcare outpaced every raise. For millions, the promise of steady work no longer buys security. But for those holding assets, real estate, stocks, commodities, each wave of inflation is a windfall. The S&P 500 multiplied nearly fourfold since the 2009 crisis, while median wages have barely nudged forward. Landlords and investors watch the value of their holdings soar, rents and dividends rising with each new round of monetary expansion. The gap widens, not by accident, but by design. Governments, too, find a hidden advantage. As prices climb, the weight of old debts melts away. The United States saw its federal debt drop from over 120% of GDP after World War II to under 40% by the 1970s, not through austerity, but through steady, managed inflation. The United Kingdom, France, and Italy followed the same playbook. Inflation quietly eroded public debt, shifting the burden from states to savers. Central banks now target inflation as policy, not as failure, knowing that rising prices lubricate the gears of credit, spending, and speculation. The middle class is left to run faster on a treadmill that never stops accelerating. Today, central banks openly target inflation, and every new dollar still flows first to those who understand the system best. Wealth divides widen as the rules reward asset owners and penalize savers. Inflation is not a glitch. Inflation is architecture. The question is, who gets to live inside its walls?